Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer? It's up for everyone to see.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent. So what's going on in the pre-market
screen? Yep. So I'll start out with the pre-market. And if anyone has a question they'd like to ask, you could put that question on the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, direct, we also put out a link to Zoom. Click on that link, takes you over to Zoom. Once you get to Zoom, there's a button, raise your hand, click on that. You don't have to turn on your video camera, but everybody will be able to hear you, and you could ask your question directly. While we're waiting for questions to come in, I'll take a look at the pre-market report. We'll see what's going on in the pre-market hours. I had a question come in from Rob, one of our regulars, how to screen out preferred stocks. So I'll show you guys how we could do that. And if any questions come in, Will, you'll stop me, let me know. We'll try to cover those today.
Perfect.
All right. So let's start out pre-market report. These are stocks trading in pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. I see we got 40 stocks on our percentage gainers list, 48 on the decliners. So from this perspective, looks like a little bit bearish bias at the open, but the lists are almost even. So let's try to filter out this list for S&P 500 stocks. So we're going to take out any closed-end funds, preferred stocks, ETFs, leverage products, just to focus on S&P 500 stocks. So to do that, I'm going to use this filter above here in ETF. I'm going to drop it down and select one of these ETFs. So SPY, that says S&P 500 ETF. By selecting it, we're going to filter out the holdings in SPY, which are the S&P 500 constituents. And we see here 3 stocks made our percentage gainers list, 4 in the decliners. So from that perspective, looks like we're pretty even at the open, so kind of neutral. Couple things. I think the ECB actually raised interest rates for the first time from 0 today. So they went from 0 to 0.75%. And we're starting to see those developed countries now tightening, so we are in a tightening kind of globally, right? Wherever you can, central banks are starting to tighten. And I believe this month is the first month that the Federal Reserve started to maximize their runoff of the treasuries to reduce their balance sheets. So I think this is the first month that they went to their, to their maximum runoff. So we are starting to see, more tightening, not just in the US, but around the world. And one of the benefits I think we had here, Will, is that we kind of started first. So the dollar started to strengthen. And I think that served a little bit of a cushion, right, against inflation, because stronger dollar our purchasing power went up from a stronger dollar. So we did have a benefit that Europe, really dragged their feet there. And that, of course, was better for us, right?
It's interesting. You're discussing Europe. I did hear a piece. It was actually on another YouTube show I was listening to tomorrow, talking about some margin call risk on European energy trades. Have you heard anything about this?
Uh, no, now that you mention it, I just saw some headlines with it, but yeah, what is it? I
Yeah,
don't know.
well, I
Exactly.
don't know exactly, but I did a quick Google search because I only heard it mentioned 20 minutes ago when I was listening to it, another show, and they brought it up and kind of poo-pooed it away as just something out there, and there's no way it could be true. But I did the search, and it's actually on Bloomberg, Reuters. Someone's describing it as a potential Lehman event, but it's I guess there's 1.5 trillion dollars in potential margin call risk out there, based
In
on
the derivatives market,
yeah,
in the derivatives market in energy.
yeah.
Right.
I'm assuming it's natural gas, and it's revolves around European energy companies. It says so. Something for everyone to take a look at. Just do a Google search. When I did a Google search, I typed in European energy, and it was the number 3 search was margin call. I didn't even type in margin call. So there are a lot of people searching it right now. So there you go.
And that's and that could be weighing on those futures, right? So it's from the long side, I imagine, right? Future traders are on the long side, and they might get a margin call if those futures decline. Is that the?
I haven't read. I'm looking at the headlines.
Right. Okay. So I guess one of the questions is, it was about preferreds. I'm trying to recollect it, from memory, how to screen for preferreds, but also there was a question, about how to get options on preferreds, and got to take a look what else, but I do want to discuss them before we screen for them. I want to discuss like preferred stock and the difference between common stock, because you won't really see options on a preferred stock. There's probably, it's a good reason why you don't, because they don't act like common stock. But before we get to the preferred stock, and I'm happy to discuss it, because preferred stock, just like common stock, it all comes down to yield, right? Eventually, it all comes down to, how much am I yielding on my risk, that I put up, right? The capital that I'm putting up. It's going to come down to that. And here, we're seeing right now, these are the treasuries, 2-year paying 3.5, 10-year 3.3, 1 month 2.3. And then we got the yield on the S&P 500 around earnings yield 4.5. We talked about these operating yields, EBITDA yield, and so forth. And when we talk about common stock and preferred, a preferred stock is almost similar to a bond. It's not exactly a bond, but it's almost similar to a bond. So a preferred stock itself, you're not entitled to the earnings of a company, right? Or the future earnings of a company. You kind of get paid either like a set amount or a variable amount. And sometimes you do have a convertible preferred that can convert to common stock, but you basically give from the preferred stock you buy, the company uses that money to invest in there, and they give you a dividend, or so think of it as an interest payment set, and it's set usually. Let's say I'm going to do Goldman one because I've owned these before. So here's a preferred stock, Goldman Sachs A. All right. So you could see here, this is a Goldman Sachs preferred stock trading $18.60, and the dividend yield's 5.1. So you could see here that the preferred stock, just pays like a quarterly dividend. This one looks like it varies a little bit. Let me try a different one. Some of them are a little bit variable, but here's another one, Goldman Sachs D. So different classes of preferred. This one pays 5.3% right now, dividend yield. Okay. And usually, like, I could just tell that the parity of this, I think it's $25. So they'll come out with a preferred, say, 4% yield parity, $25. And it could, if the yields are going up, or the perception is that there's a danger to cutting that dividend, they'll start trading below parity, right? And I think this one right now, parity is 25. So it's trading below there. Most likely it's because the yields are going up. So people are demanding a better return. So contrast that with Goldman Sachs common stock. You're getting a 5.3% return here on this preferred. When we look at a common stock, what you're doing is trying to figure out the present value of future earnings, right? So you're the present value of future earnings growth. So usually you're not going to get this kind of yield, right? You're not going to get this kind of yield on a dividend. Let's take a look. So you could see here the dividend yield is 3%. But the idea there is that if Goldman Sachs is able to grow its revenue, grow its earnings, that in the future, they're going to continue to increase it, and you might be better off in a common stock than in the preferred. Does that kind of make sense? So it's kind of trying to figure out, well, which one are you better in, right? Am I better in the common stock because I'm entitled to the earnings, to company shares, and then I could discount the future earnings growth to the present value, and that could be worth more to you than just the preferred stock just getting this. And these will tend to be, but these are capped, right? Because there's no earnings growth here. You're not entitled to the company. So you're not going to grow like a common stock. So if the common stock can continue going up, if earnings are growing really fast, revenues are growing really fast, then the stock will start going up. But this will not, share in that growth. It'll be a set dividend. So it's important to kind of understand the differences, and that's why you don't see options on preferreds, because this preferred is not going to double, triple, and just continuously go up if earnings growth goes up. Okay, so that's why you don't really see options on preferreds or these types of products. So how to screen for them? If we go to the screener, under the stock screener, this is on the stock screener, and we have stock type. So if you drop this down and select preferred, then you get a list of preferred stocks, right? So here you go. This is Broadcom, ITUB. These are different preferred stocks out here, and you kind of go through them, and we don't have a lot of analytics behind the preferreds. We used to trade them, but our focus is more, options, common stock, ETFs. A lot of people do that. There are a lot of people that just focus on preferreds, but it's more of, fixed income type of investors. If you look, there are also ETFs that are a basket of preferred. So here's iShares preferred. So this is a basket of preferred stocks, PFF. So let me just take a look at the profile here. So you can see this here has 501 different preferreds. This is its current dividend yield. And the thing with preferreds is that, from my experience, even though they stand in line, they're the first in line. If something goes bankrupt, then they're, after all the creditors are paid, the preferred stocks holders, then they're the next in line, and the common stockholders are last in line. And also, they you could, if you cut the dividend, the common shareholders will have their dividend cut first. Then the preferred stocks might get paid. If there's not enough money, they might even cut the preferred stock dividend, or what they'll do is, pay it in the future when things get better. But what I've seen is, as soon as, if there's problems with the common stock, usually you're going to see it in the preferred stock. So to the downside, you still have all the risk to the downside, and I've seen them go really down. When the stock goes, usually the preferreds go as well. And I've seen it even in big, like Fannie Mae, Freddie Mac, those things went, and so did the preferreds, right? And when there was a crisis in the banks, those also went, they went down.
Well, also, I was going to mention that was probably the best time. There were some preferreds that were,
very
dividends get too high. They're telling you something, right? You probably don't want to invest. But when there was financial crisis in 2008, there were some very solid stocks where the preferreds were yielding like 20, everything got run over, right?
Right.
Baby out with the bathwater, whatever. That definitely happened. And some preferreds.
Yeah. And you might want to stick maybe to a preferred ETF. Here's another one, VRP. This is a variable rate. So I believe that this one will reset. So this can grow. I believe this can grow its dividend yield if interest rates go up. So they kind of reset. So this is the variable rate preferred ETF. But picking out like the preferreds, for me, when I usually look at them, and you guys can do whatever you want, but I've been sticking to the big banks because the big banks kind of have this implicit guarantee of, too big to fail. So you have Goldman, Citigroup has some preferreds out there. There's a 7.5. So this one's trading above.
Wait,
parity.
You think they're going to get bailed out again?
I don't see how they won't, because at this point, what happened was the banks put themselves in a better position to get bailed out because they're much bigger now, right? They've grew their risk and balance sheets way more than they were before. So
but they've been stress tests the whole time, so everything's safe, right?
Yeah. And the problem is, who knows what these banks? Nobody can price the assets of these banks. There's nobody who can do it.
Do you think the banks have any risk to credit trading, futures, and energy?
They self-clear, they guarantee each other. There's counterparty. Really, it's like, I don't think there's any way around it. They're too big to fail, especially like JP Morgan.
Hey, D, you want to pull your mic out, maybe plug it back in? You've kind of become garbled.
Yeah, let me move it closer. I took my mic out last time.
You're good now.
Yeah. Maybe the banks are in a better position at this point from the perspective of they're not selling unlimited tail risk like they did in 2008. So that kind of risk they're probably monitoring, and they're not going to allow it anymore. But the things that they deal with is too opaque. You ever what is that? Who's that guy? Muddy Waters, the guy who used to bet long on stocks and then reversed and started to bet short on stocks, and then
mostly in Asia, right? That's where you got to start.
Yeah, but the idea there is that whenever something is not very clear to you, if you open up the books and it's not clear and it's muddy, right? Something is probably wrong, because that gives you the opportunity to really, take advantage and cook the books. And I think with the banks, that's kind of the problem, is that they trade all these over-the-counter complex derivatives with, all these interdependencies and counterparty risks and all this stuff that's going on in there, and the way they even mark and price these things, because the things that they're trading, it's like, there's no observable market prices, right? They're the market. They're the market in the things that they're trading. So that's what's happening to these really big banks. I don't think the story is going to end with '08, because it's muddy waters. That's what it is. You could go here, you could go to the SEC filings and try to, here we go.
It's Carson Block actually was the founder of Muddy Waters, just for anyone who's interested.
Right. That's why you named it Muddy Waters. Whenever, if the water is clear and you could see everything, there's less opportunity for somebody to cheat, cook the books, or have some kind of risk that somebody will be able to find, right? Somebody will be able to detect, because there's always somebody looking. Most people don't look, but somebody is going to look, but you need the waters clear. That's what happened with Bernie Madoff. Remember, like, nobody was checking his books. He was able
to. People were checking his books, but every time he would get very, very aggressive with them, and he had so much power on the street. I actually know someone personally who represented hedge fund money, and they asked her to go do an audit of his trades, and she said he was so intimidated. I mean, it was the only time she ever went in for a meeting and left feeling like she was going to bawl in tears because he was so aggressive, and she was asking all the right questions, and she had told her clients that she would stay away from him. He's just not being truthful, whatever. But and he did that to a lot of people. He bullied his way and was able, used his power to keep people from really looking at what he was doing.
And it was muddy, right? You couldn't.
Yeah, that was totally muddy.
You had to believe, like, here are the numbers. But if I just want to see, well, how did you get to those numbers? Like, where, does it make sense? Is it transparent? And when it's not transparent, and I think that's with these banks, that's always the issue, that nobody. Let me see. Let me go to the fundamentals. Let's just go. You go to the SEC website. You could open up these things and try to read through these financial statements. You're like, okay, they start telling you where they're generating these fees, and then what is the risk, right? Because a bank itself, it's not the same thing as like selling an iPhone, right? An iPhone, you produce it, this is what it costs you, you sold it, and you made a profit. But an insurance company and a bank aren't the same way. They book profits with risk on the table, right? So like mortgages, loans, derivative products that they have that could, be 30 years out, but they're booking profits every year. So think of an insurance company. Like, an insurance company sells you insurance, 30-year life insurance. Well, every year, somehow they're booking a profit. They're saying, oh, a year went by, so this is our profit for this year, this is our profit. But you need to know, well, what is the risk that they're carrying, right? What do they have at risk? And all these things are not clear. I think that the Federal Reserve, at the time of the '08 crisis, tried to figure out the risk of these banks. They said they couldn't do it. They're like, they couldn't even figure out Fannie Mae and Freddie Mac. They're like, it's too complicated. Nobody can figure this out, right? No. And let me see if I could show you, maybe, let me see if I could.
It's interesting as
might be on the balance sheet. Huh?
As you're going through all this important preferred and bank information, I'm trying to get a grip on this.
Let me see if I could.
Story about margin calls in Europe.
So,
and you mentioned yesterday that they're talking about price controls, right?
Uh, yeah, yeah. Now they're talking about price
Yeah,
control.
well, it's
They're
it's
talking
it's
about windfall tax. They're talking about these are all things that number one, they're not going to increase the supply, right? So the supply and demand is still going to remain
Hey,
out
D,
of
you got to get
balance,
closer to your mic. Yeah,
right? So what they're talking about, it has nothing to do with putting the supply and demand back
maybe
into
plug it
balance.
in and out. It's still, you still sound like you're underwater.
All right. Not well, I don't have my mic plugged in.
Oh,
So
really?
at this point, yeah, I could only reboot.
Maybe mute yourself and then unmute yourself. Let's see if that works.
Let me try. Any better?
Yep, you're good now.
All right. But we're getting, look, we only have a couple minutes. I'll take some questions now. If there are any, if not, I'll probably just stop there. I think you're on mute now, Will.
Yeah, I muted myself, so I think my voice got spun back into your computer, and that started it the cycle of the bad mic. But no questions. Bob had asked a question earlier, but you showed him how to get to the preferred screen, so that was great.
Yeah. So that's
he is asking about margin calls related to these energy companies. It's maybe something we can look at. It's something I put a link to one of the articles I found, but it's something we should all look at because it could, you toss around 1.2 trillion. It's, once you get into the trillions, it is a lot of money and could affect a lot of people. So, and there's certainly a crisis heading into Europe, their big energy season. It's going to be interesting how this plays out, and it could affect the whole world, obviously.
Definitely.
So it's something we should all keep our eyes on, and we'll take a look at see if we can figure out anything about the margin calls and how it's going to work out, Rob. But with that, D, great job, buddy.
All right. Well, thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.